You know, when you think about valuing a business, it is just incredibly tempting to treat it like you're looking up the Kelly Blue Book value of a used car.
Oh, for sure. Everyone wants that simple number.
Right. You just punch in the make, the model, the mileage, maybe you're trailing 12 months of revenue, and boom, out pops this highly objective, indisputable number. But, I mean, valuing a business isn't like selling a used car at all.
Not even a little bit.
It's much more like selling a custom-built house where the foundation is made entirely out of your own financial records. If that foundation is cracked or shifting or just completely undocumented, I promise you no buyer on earth cares about how nice the paint job is.
Yeah, or how beautiful the landscaping looks. They really don't care.
Exactly. They're just going to walk away or, they're going to demand a massive discount to take on all that risk.
And that is the exact brutal reality most owners face. And unfortunately, it's a reality that usually hits them way too late in the game.
Way too late.
Yeah. The stakes here are astronomical. Business readiness is incredibly complex, and it's highly context-specific. I mean, the knowledge about how a business is actually valued by institutional buyers is really most powerful when it's applied years before a transition or a sale ever happen.
Right, because if you're waiting until you're burnt out to learn this,
You've already lost. You really have.
which brings us to exactly what we are doing today. So welcome to this deep dive. Today, we have a very specific mission for you. We're exploring a comprehensive webinar created by Black Advisory, and it's called The Truth About Business Valuations.
It's a really great resource.
It really is, and it focuses squarely on businesses in the $1 million to $10 million valuation range.
Yeah.
It's this fascinating space that people often call the lower middle market. So our goal today is to demystify exactly how buyers calculate value. We want to help you avoid the incredibly dangerous traps of overestimating or honestly underestimating what a company is worth.
Which happens all the time.
All the time. And ultimately, we're going to uncover the step-by-step roadmap to increasing a business's multiple long before a sale is even on the table.
And that $1 to $10 million range is a highly volatile space to analyze. It's the segment where a business is transitioning from being, well, basically just a high-paying job for the founder into being a true standalone asset.
Yeah, a massive shift.
Right. But getting a sophisticated buyer to actually view it as a valuable asset requires understanding the foundational math they use. Because buyers in this space, they're entirely unsentimental.
Okay, let's unpack this. Because to understand how to raise a business's value, we first have to understand that core math. If you've been around the business world, you know the formula usually boils down to earnings multiplied by a multiple.
Simple enough on the surface.
Right. For smaller owner-operator businesses, it's SDE, or seller's discretionary earnings. For businesses over $1 million in profit, it's EBITDA. But let's elevate this for a second. Well, we all know EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
The classic acronym.
Right. But why is this the universal language? I mean, why do buyers insist on stripping all of those specific things out of the profit number?
That is the perfect question, because the why is what most owners completely miss. Look, a buyer strips out your interest and your taxes because they are going to have a completely different capital structure than you do.
Ah, okay.
Yeah, I mean, your business might be completely debt-free right now, but the buyer might be using a massive bank loan to acquire you. Your tax strategy is based on your personal life, but their tax strategy will be based on theirs.
So they just want a clean slate.
Exactly. The buyer needs to strip away all the noise of your specific financial setup to see the raw, operational, cash-generating power of the machine itself. They're buying the engine, not the way you financed the engine.
So EBITDA is really just the pure horsepower of the business.
That's exactly it. The formula is simply that pure horsepower, the adjusted EBITDA, multiplied by a risk factor, which is the multiple.
But wait, if the formula is that straightforward, right? Just multiplying the engine's horsepower by a multiple, why is the webinar titled The Truth About Business Valuations?
Well,
I mean, if we all agree on what EBITDA is meant to measure, why are valuations so contested? Why do sellers get blindsided so often?
what's fascinating here is that the mathematical formula itself isn't the complex part. The complexity, the friction, and honestly, the absolute danger all lie in interpreting, negotiating, and verifying the exact numbers you plug into that formula.
Because the numbers aren't just handed over on a silver platter.
No, not at all. Neither the earnings number nor the multiple is an objective fact. They are highly subjective, heavily debated battlegrounds.
Because getting to that final, agreed-upon earnings number isn't just handing over a tax return. A tax return is built to minimize profit so you pay less to the government, right?
Exactly.
But evaluation requires maximizing profit to show the buyer the potential. So this creates a massive conflict, which requires this heavily scrutinized process called normalization.
Precisely. Normalization is basically the art and science of adjusting a company's financial statements to reflect what the business would actually look like under typical new ownership.
hmm
You're stripping away one-time anomalies, market fluctuations, and most importantly, owner-specific quirks to reveal the true earning power.
I always think about normalization like staging a house for sale.
Oh, that's a good analogy.
Yeah, because when you live in a house, you have your quirky furniture, your kids' drawings all over the fridge, maybe a giant eccentric chandelier you installed in the living room. But when you sell it, a good real estate agent makes you clear all of that out.
You paint the walls neutral.
Exactly. You take down the family photos. You want the buyer to see the actual structure and imagine their own family living there rather than being distracted by your highly personal choices.
That is a brilliant way to look at it. In a business context, clearing out the family photos means adjusting the financials for things the new buyer simply won't be doing. The source material highlights owner compensation as a prime example of this. Let's say you own the business, it's highly successful, and you pay yourself a salary of, say, $350,000 a year. But the operational reality is that a buyer could hire a competent market rate replacement CEO to do your exact job for maybe $120,000.
So there's a $230,000 gap between what I pay myself and what the market demands.
Right. So during normalization, the seller's CPA takes that $230,000 difference and adds it back to the bottom line earnings. It's literally called an add back.
Okay.
You're telling the buyer, hey, look, here is an extra $230,000 in true structural profit that I was just taking out of the business as a bloated luxury salary.
Wait, if I'm a seller, though, isn't this normalization process just a massive loophole? I mean, it sounds like a cheat code.
How so?
Well, can't I just go through my books, find every single dinner, every vacation, every vehicle lease, claim it was a personal perk, and artificially inflate my EBITDA?
Yeah,
It feels like cooking the books in reverse.
If we connect this to the bigger picture, that exact instinct is what destroys deals at the 11th hour. The webinar explicitly warns about this. They call it add-back risk.
Oh, wow.
Yeah. When a buyer issues a letter of intent, it's usually contingent on a quality of earnings report or a Q of E. They send in their own forensic accountants to verify your add-backs. And aggressive or undocumented add-backs are the #1 reason deals collapse.
Just because the buyer's accountants call your bluff.
Worse, it creates psychological contagion.
Psychological contagion.
Yeah, because every single add-back must be legitimate, meticulously documented, and entirely defensible. If a seller tries to claim $50,000 in travel expenses as a personal add-back, but the buyer's CPA finds out some of those flights were actually necessary to visit key clients,
Oh, they strike it down.
they strike it down. But they don't just kill that one specific line item. It destroys the buyer's confidence in your entire financial foundation. The buyer's thought process immediately becomes, well, if they lied to me about the travel expenses to inflate the multiple, what else are they hiding in the inventory?
Right. Are these customer contracts even real?
Exactly.
It's the cracked foundation of the house again. Once they see one crack, they assume the whole slab is sinking.
Precisely. The trust completely evaporates, and the buyer either walks away entirely or they demand a massive discount to compensate for the newly discovered risk.
That makes total sense.
Hmm.
But let's say you run a tight ship. Your financials are pristine,
yeah.
your add-backs are fully verified by a CPA, and you have defended an airtight adjusted EBITDA of $2 million. You've won the earnings battle.
Okay, good start.
But you still aren't safe, because buyers can look at those identical earnings and offer wildly different checks based on the second half of the formula, which is the multiple. And this brings us to a concept the source material calls the multiple myth.
Oh, the multiple myth is a pervasive and incredibly costly illusion. It's the idea that a founder hears a rumor at an industry trade show and thinks, well, software businesses in my sector sell for 5x earnings. Therefore, my business is worth 5x.
Right, I just apply the multiplier and I'm done.
Yeah, but yes, industry averages exist, but they are just baselines. They completely ignore the operational reality of the specific company.
The webinar gives a staggering example of this that we absolutely have to dissect. It presents two identical businesses in the exact same industry. They both generate exactly $2 million in verified EBITDA, so the earning power is its high.
But the operational structures are night and day.
Right. The first business is completely owner-dependent. The founder holds all the client relationships, the processes are just locked in the founder's head, and 30% of the revenue comes from just two major clients.
A nightmare for a buyer.
Truly. So a buyer looks at that and offers a 3x multiple. 2 million times 3 equals a $6 million valuation. But the second business is highly systemized. Its operations are fully documented, it has a strong middle management team, and no single client makes up more than 10% of revenue.
Much better.
Right. A buyer looks at that and offers a 6x multiple. 2 million times 6 equals $12 million. Here's where it gets really interesting. We are talking about a $6 million gap in valuation on identical earnings.
Identical earnings.
$6 million. What is the exact mechanism that causes a buyer to look at the exact same profit and swing their offer by $6 million?
It entirely comes down to risk of transition. When a buyer writes a check, they are not paying for what you did in the past. They are paying for the right to access your future cash flows.
Yeah.
The buyer is trying to calculate the probability that those $2 million in earnings will actually continue to materialize after the current seller walks out the door. The less risk there is in the transition, the higher the multiple they're willing to pay.
So it's not really a reward for being organized.
Yeah.
It's an insurance premium against the business falling apart.
Exactly.
Knowing that, we really need to understand the operational realities that either introduce risk, which destroy the multiple, or eliminate risk, which raise it. The Black Lake Advisory webinar divides these into the destroyers and the raisers.
Let's analyze the destroyers first, because these are the silent killers of valuation. The single biggest discount factor is owner dependency.
I can imagine.
If a business cannot function for a month without the founder stepping in to close a deal or fix a supply chain issue, it is priced accordingly. Buyers will routinely discount an owner-dependent business by 1 to 2 full turns below the market average.
Wow, 1 to 2 full turns. Let's put a scenario to that. Imagine a B2B logistics company making a healthy profit, but the founder is essentially the chief revenue officer. The founder plays golf with the top 3 clients.
A classic setup.
Right. If I am a private equity buyer, I'm looking at that dynamic and thinking, well, the moment I buy this company and the founder retires to Florida, those 3 clients have no loyalty to me. They might just leave.
Oh, they probably will leave.
Right. So I have to discount my offer by millions of dollars just to hedge against the fact that I might lose the revenue I just paid for.
That is exactly how they underrate the risk, which ties directly into the next massive destroyer, which is customer concentration.
Great.
If 30% or more of your revenue is tied to just one client, you don't actually own a business. You are essentially a subcontractor for that client.
Ouch. That's true.
It is. If that client demands a 20% price cut the day after the new owner takes over, the new owner has absolutely no leverage. They have to accept it, or the business goes under.
And another destroyer they highlight is declining margins. Why do margins matter so much if the overall revenue is still growing? I mean, growth is good, right?
Yeah. Well, because shrinking margins signal operational decay. If your revenue is up, but your profit margins are compressing, it tells a buyer that you have zero pricing power in your market, or your cost structure is bloated, or maybe you're having to buy your growth through unsustainable marketing spend.
It's a red flag.
A huge one. A sophisticated buyer sees declining margins as a symptom of a much deeper disease.
Okay, so those are the destroyers. Owner dependency, customer concentration, declining margins. Let's look at the raisers, the operational realities that actually earn you that premium 6x or 7x multiple.
The raisers are the structural antidotes to risk. The absolute holy grail is recurring or contractual revenue.
Makes sense.
Yeah, if every dollar of your revenue has to be hunted and killed every single month, that's high risk. But if you have subscriptions, long-term retainers, or multi-year contracts, you offer the buyer predictability. And predictability always commands a premium.
And to combat the risk of things being locked in the founder's head, you need to look at documentation, right?
Yes, absolutely. A comprehensive, rigorously maintained SOP library standard operating procedures covering all core functions is vital.
So not just a dusty binder on a shelf.
No, a living document. It signals to the buyer that the business is a systemized machine that can be transferred. And coupled with that is management depth. Having at least 1 or 2 capable leaders who run the daily operations independently of the founder dramatically reduces the buyer's transition risk.
So what does this all mean? When you look at all these razors securing recurring revenue, documenting every process, building a management team to handle the daily fires, it really reveals the ultimate paradox of building a high-value
Yeah,
business.
it does.
Because all of these steps require you, the founder, to build a machine that proves to the buyer you are completely unnecessary to its success. Your ultimate goal is to make yourself obsolete.
This raises an important question, though. How does an owner actually achieve obsolescence? I mean, it's easy to say build management depth, but you can't just wake up on a Tuesday and decide to have a fully autonomous team and a beautifully documented operation by Friday.
Right.
It requires a fundamental shift in how you operate.
Yeah, I can't just hire a consultant to come in over a long weekend and write up some SOPs to instantly double my multiple, which actually takes us to the actionable roadmap of the webinar, which is the 3 to 5 year valuation playbook. The source material is adamant that fixing these structural risks takes significant time.
That might be the most crucial takeaway from the entire deep dive. Valuation improvement is a 3 to 5 year strategic initiative. It is absolutely not a 90-day project you tackle right before you list the business with a broker.
No quick fixes.
None. The playbook lays out 4 specific priorities that must be executed, and the sequence of these priorities is non-negotiable.
Okay, let's talk about that sequence. Because priority one isn't hiring managers or writing annuals. Priority one is clean up the financials. And they allocate 12 months or more just for this one step.
Because without clean financials, nothing else matters. You have to engage a high-level CPA, ideally transition to accrual basis accounting, reconcile years of messy records, and meticulously document every single add-back going forward.
But why does this have to happen first? Like, why can't I build my SOPs while I clean up the books at the same time?
Because institutional buyers operate sequentially during due diligence. The very first thing they will look at before they meet your team, before they look at your products, is the financial data.
Oh, I see.
Yeah. If they asked for 3 years of CPA-prepared, audited, or reviewed financials and you hand them a messy QuickBooks export, the deal is dead right there. They won't even stick around to see the SOP library you spent a year building.
Wow. The foundation of the house again. If the inspector sees the foundation is crumbling, they don't walk upstairs to admire the crown molding. Okay, so once the financials are bulletproof, we move to priority 2, which is reduce owner dependency. The timeline here is another 12 to 24 months. This involves systematically delegating functions and transferring key relationships. And there is a specific, pretty brutal test the source suggests for this.
Oh, yeah. The vacation test.
Yes. If you own a business, or frankly, even if you just manage a large division in a corporate setting right now, imagine taking a 90-day vacation starting tomorrow, completely off the grid.
No emails, no checking in.
Right. No Slack, no quick phone calls to approve a discount. Would your operation survive, or would it collapse into chaos? The playbook says you should literally test the business without you for 30 days, then push it to 60 days, and finally 90 days.
It's an emotionally terrifying test for a founder whose entire identity is wrapped up in being the indispensable problem solver.
Oh, absolutely terrifying.
But it violently exposes exactly where the business is broken. Once you run that test and find the breaking points, you move to priority 3, which is document core operations. This takes another 12 to 18 months. You build the complete SOP library to patch the holes you found during your absence.
You're literally writing the instruction manual for the machine you just built.
Right.
And then finally, priority 4 is diversify revenue. They allocate 24 to 36 months for this. This isn't just a marketing push. This is a strategic mandate to actively acquire new accounts or enter entirely new markets, specifically so that no single client represents more than 15% of your total revenue.
And you can see why this takes years. You cannot diversify away a dominant client overnight without accidentally shrinking the business.
Because you still need their money.
Exactly. You have to aggressively grow the bottom 80% of your client base to dilute the top 20%. It requires sustained strategic effort.
Well, we have covered a massive amount of ground here today. From the deceptively simple EBITDA formula to the psychological warfare of the quality of earnings audit to the incredibly costly multiple myth.
A lot of ground.
Yeah, but I think the most important thing to pull from this Blacklick Advisory deep dive is how profoundly relevant this framework is to your everyday life, regardless of your actual title. I mean, even if you aren't planning to sell a business anytime soon, even if you just manage a department, lead a small team, or run a nonprofit, understanding how institutional buyers underwrite risk makes you a significantly sharper, more disciplined operator.
I completely agree. I mean, tracking where your revenue or your resources are concentrated, meticulously documenting your internal processes so you aren't reliant on one superstar employee, and ensuring clean, transparent financial reporting.
Right.
These aren't just parlor tricks to impress a private equity buyer. They are the fundamental best practices that make any operation more resilient, more scalable, and frankly, just less chaotic to run.
And that leads to a really profound, almost ironic thought to leave you with today. The ultimate irony of business valuation is this: the exact steps required to make a business highly sellable, removing yourself from the daily grind, securing predictable, recurring revenue, and building an autonomous management team that doesn't need you to function.
Hmm.
They were the exact same steps that make a business an absolute joy to own. If you spend the next 3 to 5 years grinding through this playbook, systemizing everything perfectly to earn that premium 7x multiple, you might just find you've built the ultimate passive income engine.
That's the dream, isn't it?
It really is. Your foundation is rock solid, the house runs itself, and you're left with a fascinating, unexpected choice. Once the business is perfectly ready to sell, do you even want to sell it anymore?